The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, this is Esther Gulius, the tax lady from EG Tax, and this is our hour to talk about taxes, not like anybody else is talking about taxes. I mean, this time of year, we're talking about turkey, stuffing, we're talking about Christmas holidays, but we're also going to talk about taxes. Now, most of the time we take, 99% of the time, we take your calls, and we would love to take your calls, but today we're doing emails. So like 3 or 4 times a year, we just do emails, and this is our email Saturday, so don't call in. Not this week or next week. We're going to do emails 2 weeks in a row. But after that, we should, we're going to keep you abreast of all the pending tax law changes and everything. So I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey there, Esther.
You got your turkey?
I do have my turkey, and I wish I didn't have to make a turkey. I wish that somebody else would make the turkey, but I'm making the turkey.
Yeah, but it's wonderful. I mean, they say, and it is true that they say the tryptophan or trypto something's in there makes you sleepy. But and Christopher?
Oh, sorry, turkey making me tired. Hello, Esther.
Nobody should eat as much as like on Thanksgiving too. Do you think?
I don't think anybody.
Me, I'm always watching my weight. I'm watching it bigger, watching it smaller. Anyway, I'm Esther Gulius, the tax lady from EG Tax. All of our offices are going to open mid-January again to serve you. We have some kind of new things that are going to happen this year, right?
Yeah, we have
in the tax business.
We have a new location in Lewiston. I was going to say virtual receptionist, but we have a new location in Lewiston, New York. So that's really exciting. That's on Cayuga. We do have a virtual
receptionist. If you've gone to some of our offices, you know that sometimes the tax accountant is with a client and maybe there's no receptionist on duty, and we wanted to make sure that everybody knew that they were served. So we have a little check-in screen where you can check in and say, I'm here, and it goes right to the preparer so they know that you're in the office. So that'll help.
It's pretty
right?
cool. And then it captures your cell phone number, so afterwards you can rate the service, which I think is really cool.
And then don't we also have something to say about loans for holidays?
Because he wanted to know you were going to talk to the bank product place, and I don't think it's still in the works.
We're waiting for it. Give us a call. We'll let you know what we can do.
So we may be doing
Yes.
holiday loans, right?
Yes.
But of course, during tax season, we have you don't have to file using any cash of your own. We can take the refund, take the fees out of your check, you
Right.
know. And all right, so. Without further ado, I'm Esther Gulius, the tax lady. We're going to talk about emails that you guys have been sending in. And so, Chris, shall we start with you?
I got Dave.
Got it.
I'm going to chime in. EG Tax. I was told that I need to do a full set of dental implants at a cost of $30,000, and dental insurance won't pay for any of it. Should I get a home equity loan to pay for it, or should I go on a payment plan with the dentist? Is any of it deductible? Well, I'm thinking if they change the tax code, you could never deduct it. But
Well, I will tell you, some of the pending tax law changes are an elimination of effectively all itemized deductions. And I'm going to kind of get on my soapbox here.
please do.
The itemized deductions really weren't for upper income people. If you really were an upper income person, the itemized deductions started to phase out. So you didn't get the itemized deductions. Itemized deductions really were for normal people. And one of the itemized deductions was medical. So pending the outcome here of what's really going to shake out of Congress, out of the House and Senate, but it looks like they are definitely looking at eliminating itemized deductions. So if you can get those choppers paid for before the end of this year so that you can deduct them on your 2017 return.
Even if you get a home equity to pay for them, you could still deduct it on your 17
right.
return. What were you
Well, I
going
was
to say?
going to say, you not only get the medical, but if you do the home equity, you could have the interest you pay on the home equity as a deduction as well.
Right, which
So
won't be very much this year, but, and one of the things they're saying they're going to keep in is mortgage interest. But again, it'll be really difficult if you're a married person to itemize. If,
Yeah, the
if
$24,000
right,
is
if
a high
that-
figure.
If what they're talking about it comes to fruition.
Yeah.
So get them choppers paid for. Borrowed money paying for expenses that are deductible are still deductible.
I had a client who came in the other day, and he had a big medical cost, and he wanted to take money out of his IRA to do the procedure, and so I mentioned to him the home equity. So it's a viable option, something to think
Okay.
about.
All right. By the way, I want to make things clear for people. When they talk about doubling the standard deduction, here is the analogy. Well, first of all, when they double your standard deduction, they aren't mentioning that they're taking away the personal exemption, which was $4,150. So if you had 4 people living in your home that were dependents, you are losing $16,600 in write-offs. So they're giving you $24,000, but taking away, in your situation, $16,600. So it's like saying your boss coming into you and saying, "Hey, Chris, I'm going to double your salary," and you go, "Yay, that's so cool." But now you have to pay 90% of the increase to park in the parking lot.
Right. But so in your example, the married couple with 4 kids, we're already not counting itemized deductions. We're at 28,000
Right.
in deductions.
In
So now they're at 24,000. So they're losing $4,000 of a deduction. Doesn't sound like a good thing.
Right. Now, it is true that they increased the
Child tax.
child tax credit they're looking at $1,600, but even with that, the extra $4,000 you're losing if you're in the 25% bracket, that's $1,000 in taxes. The extra child tax credit would be $1,200, so you would be marginally better. But if the child turns 17, you got to throw the kid out of the house because you lose everything.
And you know what I want to say? You said 9. You'd have to pay 9. You're getting $1,000, but you pay $900 to park in the backyard. Many times you're actually paying more in your example to pay.
Well,
in the
and the other thing
parking
is
lot.
we haven't even talked about New York State.
Right.
Because New York State is a state that follows the federal in itemized deduction. Well, if you can't itemize on the federal, you can't itemize on the state. And if your standard deduction is 24 on the federal and it's 13 on New York State, that means you're getting shafted by $11,000 that you absolutely can't if you had itemized deductions.
And that's one thing you hear all the time on TV, federal. You don't hear any, not just New York State, any states saying, wait a minute, what is this going to do to us? What are we going to have to change,
see,
if any?
The rhetoric, and again, I'm a conservative, all right? But the rhetoric, and I just hate when people get lied to, the rhetoric is that the states that are bad money spenders, they fiscally irresponsible. Why should the federal government pay for fiscally irresponsible states like New York and New Jersey and Massachusetts and Pennsylvania and Illinois?
That gets me so mad when I hear that.
California. But, those of us that live in those states, you just can't kind of say to your boss, well, I'm leaving, I'm going to go to another state. New York State is your home state. And the reality is it's expensive to live here. You're paying more in expenses for gasoline, property taxes, mortgage interest, income
Sales tax.
taxes.
I don't you mention that.
So it's a very sad thing. But anyway, I don't want to belabor the thing, but I did have to get a little bit on my soap opera and soapbox and talk a little bit about that. I'm Esther Golias, the tax lady from EG Tax. We're not taking your calls this week as we approach Thanksgiving, but and next week as well, we're doing emails, so it gives you a more in-depth look of how we think about taxes. And I will tell you, anybody that, as this stuff starts to unroll and unravel with the House and Senate, if you want to call and find out how much your taxes will be impacted, you can call EG Tax at 632-7886, and you can just give us the figures over the phone, and we'll tell you if you come up on the plus or the minus side of tax reform. Okay, we're going to take a short break. We'll be right back with no phone calls, with the rest of the emails. Hi, this is Esther Golias, the tax lady from EG Tax. We're talking about emails and the proposed tax law changes. We're not going to be taking your phone calls this week or next week. We're just doing emails. So, but of course, anytime during if you feel like emailing me right now, a tax question at egtax.com, I'll be very happy to answer it. But we're not taking live phone-ins today. Okay, who's got the next question?
I got Tommy. It says tax
Tommy.
people. Tommy. I really have a lot of credit card debt. It's driving me crazy. Creditors call all night long. So I'm thinking about taking $50,000 out of my pension to get straight. If I would withdraw the taxes, how much will this cost me?
Okay, well, first of all, it sounds like Tommy is under the age of 59 and a half.
Right.
Okay, if he's over the age of 59 and a half, even though it's bad, it's not as bad. All right, first of all, what do we know about pensions? We know that
They're for
that's
retirement.
Yep,
They're
they're
sacred.
very sacred.
And they're sacred. They're a holy item.
Right.
Because even the state of New York says if you go bankrupt, you don't have to take the money out of your pension plan because we want you to have the money for when you get old, right?
Yep.
So they're holy. And so the first thing I see is how bad is Tommy's credit?
Right. Well, if he's owes $50,000 in debt,
And people are calling him all the
him.
time.
Not good.
You think Tommy's got some bad credit?
I
Yes.
do.
Okay. So if that's the case and you got bad credit and you want to straighten out your life, the first thing before I take money out of my pension plan, which is holy, I would go talk to a bankruptcy attorney. Mm-hmm. Because even though bankruptcy is not something that you would aim for, it is something that's in the law to help you to get straight without stealing from your future pension retirement. And so you say to yourself, yeah, but it's going to ruin my credit. I don't know whether you know it, but if you run your credit is probably bad already.
Right.
Once you do a bankruptcy, that is at that point in time, you're able to rebuild your credit again. And until you pay off your debt, you're not going to start to rebuild your credit. So if you just keep that $50,000 in debt for next month, next year, the year after, you may be able to make minimum payments. Your credit score stays bad. So that's bad. If you take money out of your pension plan, you're ruining your future. So the first thing I think of is to go talk to an attorney about a possible bankruptcy.
And it's so funny when you say that. You're like, if you keep that debt, it's like you're lumping along with that big thing chained to your
It's
ankle.
like a dead body.
Yep, just cut it off. And,
I mean, they're not.
Yep.
They're bankruptcy protection is protection.
Yeah.
It's meant to be a thing that helps you in the event that you made some bad decisions or had some terrible life situations that had you go into that, or maybe you just made, you just went nuts one day and went down to the mall and started spending a bunch of money. The thing is, hopefully there was a lesson learned and you're not going to do that again, and a way to get out from under is to do the bankruptcy. Now, if Tommy says, nope, I want to take the money out of my pension plan, let's talk about what his liability is going to be.
well, if he's under 59 and a half, first thing you have the 10% penalty
On the
so
distribution.
So that's $5,000 on the federal. But then you got to look at the income tax side of it, both for the federal and New York State. So adding $50,000 to his income, depending on what it already is. So we'll be nice and say it's still at 15%. He's looking $7,500 to the federal, plus that $5,000 penalty. So that's $12,500.
Plus New York State.
Plus New York State of, we'll say, 6%. So that's another $3,000. So he's looking 12, about $15,000. He's
On 50.
on 50.
If he's in the 15% bracket, but if he moves to the 25% bracket, now we're looking well over 20,000. That is unbelievable. Think about that in terms of interest that you're paying on your credit cards.
Yeah.
I mean, effectively, to pay it off, you're going to pay, with state of New York and penalties, about 45%. That's a lot to get rid of.
I mean, you're
So-
going from one debt to a
to ano-
different
right.
debt.
Yeah.
And so at tax time, I mean, for you to pay off the 50, if it's 20,000 in taxes you owe, you're going to have to take out 70,
Yeah.
right?
Yeah.
And that's going to be even
And
more,
more
taxes.
taxes.
And another thing is, you've always said, rightfully so, we don't live in a country where there's a debtor's prison. And so your pension is holy. I think it's just important to
Yeah.
leave it at that.
You know, we're not even, it doesn't say if
And
he's
you've had clients. I know I've had a number of clients who I've said to them, you really need to do a bankruptcy. And they said, oh, I don't want to. And I know they don't want to. But when they do they just come in singing a happy tune the next year.
Yeah.
I mean, because they get the monkey off their back.
That's right.
You know, and I know that it's published in the paper, but it's not like your friends are saying, "Oh my God, look at that, Heather went bankrupt." You know, I mean, they just don't do that. So, I would suggest you talk to a bankruptcy attorney. I know Dennis Kitchen does bankruptcies. He's one of our sponsors, a wonderful man on Main
He's
Street in
helped a
Clarence.
lot
So,
of my
yeah.
clients. Yeah.
Okay, all right. What else do we have here?
We have Esther. Help. I recently received a letter from New York State Tax, and they said that in 2014, when I claimed my son's college, I was not entitled to the credit. I think that I was entitled to the credit. What should I do? Margie and Don.
Well, I was wondering if I could chime in on a lot of those statements that you get from the colleges on the 1098Ts. If you are a graduate student, it's marked. And so New York State is seeing that that's marked on the 1098T. But the truth is, a lot of my clients, half of the year they were working on their bachelor's and half they were working on their master's. So in all fairness, that's not correct when on the 1098T it's marked that they're a graduate student because half of the year they were undergraduate. So they should get a bill.
And it all depends on how they claim the
Statement.
credits in the past, right?
Yep.
And so let's go back and talk about what the different kind of credits are.
Yep.
Okay, so the first credit is the American Opportunity Tax Credit,
Mm-hmm.
and that can be taken on the first 4 years of higher education.
right, for the federal.
Right, for the federal and the state.
Well, the
258.
AOTC is a federal. The
Yeah,
New
but I
York's
mean,
credit
I'm
is,
saying the credit
Yep.
is also for the first 4 years of higher education
Yes.
in New York State. So that's that credit. The 5th year forever that you're going for higher education, that reverts to the lifetime learning credit, right?
Yep.
So that credit would be available to that client one way or another, but you can't combine credits. You can't
Correct.
do the lifetime learning and the American Opportunity
Right.
Tax Credit, right? So if she did not, in the first year, like let's say that her child was in school that September, if she didn't take the AOTC, which I doubt, and then the next year when the child was a sophomore, she took it, and after the junior, then senior, then it would mean that the 1098T would have been misleading, like you said. But if she took it that first year in September, and then the next year, and the next year, and the next year, and the senior year in January, that would not. She would have already taken 4 years of it, right?
Well, but Chris
For New
has always told me you could have as many bachelors as you
For
want.
New York State, you can have as many bachelors
but
as
not you're limited to 4 on
for the AOTC.
right on the AOTC.
Right, right.
Right.
You get the lifetime after that.
Right.
This lady's writing in it. It's New York State that's
Oh,
questioning
okay.
it.
That's,
so,
well, New York State then is you have to be very patient with them because they really make a lot of money sending out these letters.
Yep.
So what you want to make sure
It's
is
like they're
you can
dredging.
call us. We'll be very happy
Yep.
to help you.
It's like they're dredging and they're just spinning.
They
and
seem to be dredging successfully, though.
yes, they do.
maybe they could be dredging the Lake Ontario so it doesn't flood again.
That would be nice.
Okay,
right, what
I
else we got?
got a question, and this is from Dorothy. EG Tax. My mother is 84 and likes visiting the casino. Is it true if she wins, she'll be able to claim her losses with the new proposed tax changes?
Will not.
Be able to.
Oh, well,
Not be able to.
Not,
So here's the
not.
thing. If what has been bantered around goes into effect, there are medical bills that won't be deductible, state and local withholding sales taxes won't be deductible, much interest from mortgages won't be deductible, investment interest won't be deductible, casualty losses won't be deductible, business expenses, travel expenses, office and home, continuing education, investment expenses will not be deductible, and neither will gambling.
which is, I mean, because the sad part about when seniors gamble is it makes more of their Social Security taxable.
Right, and so now it'll not only make the Social Security, it'll be taxable on line 21. So
Well, that doesn't
that's
sound like a winning
not good.
proposition.
That's not good.
No. So
No
what
winner,
you,
winner, chicken
so
dinner.
what Dorothy heard was correct. And
it won't be
and
deductible.
it's
So
very
you
smart
wanna-
that she's asking the
You want to
right
make
questions.
sure that what you need to do is contact your representative,
Mm-hmm.
and I know they're saying, but they're doubling the standard deduction and taking away the personal exemption and making a lot of stuff not deductible.
But I mean,
Talk to your representative. Maybe they'll let you net the winnings from the losers eventually.
right. But let's look at Dorothy, who's 84 years old. Okay, she's single at $6,300. She's over 65, so that's an extra $1,500. So that brings it up to 78. Plus her personal exemption brings it up to another 4, 12, 13,000.
Right, and that's
So-
and there's her new standard
Deduction is
12.
12. So she's losing $1,000.
Right.
So,
Seniors are really getting hit, and head of the household.
yep, because they're not even talking about head of
It
household.
looks like 2 filing statuses: single and married joint. That's it. Wow. So.
Another happy day.
Right.
No- no
and then
married
somebody,
no
then
married-
somebody says to me,
No
but
married
it's going to
separate."
be simple. It'll be simpler. And I said, well, you know what's really simple is you keep all the money and send me what you're going to allow me. That is really simple.
Well-
but itemizing at least give you an opportunity to take expenses that were extraordinary for your lifestyle.
Right. I mean, look at Europe. A lot of these people don't realize in Europe, these countries, if you make $1, you give the government 40 cents right away. There is no tax return because they're
They do
getting
it.
40 to 60% right away off
Right.
your paycheck. So you're complaining you're paying 10% or 15%. It can be a lot worse.
We could become a socialistic country.
Which we're headed for.
It says Esther with the. Are we going to
Oh,
time
you know
for a
what?
break?
I think what we have to do is we have to break for news right now. But hold that thought, Tiff, and
I
we'll
will.
be right back. I'm Esther Golias, the tax lady from EG Tax. We're answering your email questions this week and next week, and we'll be back on the other side of the news. Hi, I'm Esther Golias, the tax lady from EG Tax. We're here and we're talking taxes, and we're talking about some of the upcoming potential tax law changes. We're going to help you with those. But this week and next week, we're just doing emails, so we're not taking live phone calls. But I will tell you, if you have questions during the week, or even right now, you can get us online at egtax.com, ask the tax lady, and I'll answer you right back. And so, Tiff, just before the break,
There was
ask me a question.
Peter asked Esther, we have a second home in South Carolina that we've been able to write off the property taxes and mortgage interest. If the tax changes occur, does it mean we can't deduct these anymore?
Yep, that's what it means. That's exactly what it means.
Well, they tweaked the
but-
law a little
but
bit where
here-
you could
but here's
deduct
the thing.
$10,000 in taxes, right?
But that's on your
personal
primary
property.
home. All right, so here's the thing that I think of, because this is going to affect a lot of people who knew that they could write off their property taxes and mortgage interest if they bought a second home, vacation home.
right.
But what's fully deductible is those expenses on a Schedule E.
Yep.
Yeah.
So if I were you, Pete, especially if this is going to be a strain on your budget, I think you ought to think about converting your second home into a rental property,
Yep.
and then using it less than 10% personally, or 14 days or 10% personally, and then all the expenses are going to be deductible, including mortgage interest, property taxes, repairs, travel to go, take care of the property, painting, landscaping, insurance,
Boy,
and
oh
everything.
boy.
So I would and that's really
A
what
lot of
people
people are
going
gonna
to
do that, yeah.
They really have to start thinking about what's personal use and what's business use,
Right.
and really they need to get their heads screwed around that maybe what they ought to do is do some tax planning, because the average guy is who's going to get it in the neck here with these proposed tax law changes. So that's what I
I'm
think
telling
we should do.
you, I could see lobbyists who are casino owners. I could see real estate people be
the real estate,
lobbying.
builders and realtors are going nuts.
Oh
you know.
my God, that's just
Okay, so
pathetic.
that's what I would suggest you do. And then let's say they rent out their South Carolina home for 300 days a year.
right.
They can use it 30 days personally, right? Which may be all that they're using it for anyway.
right,
And I
right.
know a lot of people say, "Oh, I don't want people's dirty underwear in my washing machine at my house," and that's a trade-off.
Yep. Yep.
But it would be a way to preserve the deduction.
I could see a lot of people having to move in that direction.
And not just a deduction. How about a loss? It could potentially be a loss on your tax return.
Yeah.
After you take off all your other
expenses,
expenses,
right.
the utilities, the insurance, the repairs,
Right.
the supplies, the
And the
maintenance.
depreciation.
Yeah.
Right.
So
Okay.
I got Ali. Ali says from Niagara Falls, Esther, I am an Uber driver here in Buffalo, but I used to drive in Ohio, and I didn't include all of my income for driving on my 14 returns, so the IRS changed it on me. I am on a payment plan with the IRS. Any suggestions on how I can pay this faster?
Okay.
Well, I'm thinking that maybe Ali needs to amend the return instead of having the IRS force his hand. And maybe there's expenses that he didn't include against this income that he earned from being an Uber driver in Ohio.
Well, that's the thing. If he didn't include all the income,
Right.
did he include all the expenses? And why didn't he? I thought they give him a 1099. Why wouldn't he include all of his income? That's strange.
Why do people do what they do?
Yeah, but when you get a 1099, it's
there's
like
I've
a
seen
people who
people
just-
do that all the time.
Yeah.
Yeah. I've seen people who do that all the time.
They don't think the IRS got a copy of it? And
I
they
don't
put
know.
it in their little machine?
Because I
and
think
out
they get a
pops letter?
1099K, and I don't know if they don't know what a 1099K is, but they don't include it. And so
Well, that's what I would suggest he do is make sure that it sounds like he might have done his own tax return. Make sure you have somebody look at it professionally to make sure that you've taken all your expenses. You know, if he is a full-time Uber driver, maybe instead of taking mileage, he wants to do actual expenses because maybe that
Right.
would be better than taking the mileage rate. So,
And now that he's driving in Buffalo, he's going to want to make sure that he takes really good care of his records. I know Chris just had an Uber driver come in a couple days ago, and did consultation with them, right?
Yeah, wanted to know how about prepayment
Yeah.
because she works full time and does Ubering at nights and on the weekends. So, you know,
prepayment. Explain that to people.
Yep. So you could prepay the government, give them
you're supposed to
quarterlies,
do.
right? In April, June, September, and January. So because they want their money throughout the year, and if you don't do it and you owe them money, they're gonna
They
penalize
penalize you.
you, right? But she, she was smart. She goes, "Can't I just change my withholding at my full-time job because I'm claiming
that's very
7
good.
right now?
Oh, that's
Can't
very
I
good.
just bring it down to like 1 or 0?" I said, "Yeah." She goes, "Okay."
That was a very
But
good
yeah,
idea.
so I mean, but there are people
They don't
out
care
there.
how they get their money
Right.
as long as they get their money and it's in advance.
Yeah.
Right.
And I wanted to say one other thing about Ollie. So right now it's easy to keep track of all your expenses. It's going to be really hard for you to amend your 14 return and recall all those
I know how
expenses.
how Ollie can. He needs to get our app.
That's right.
If you get the EG Tax app, right,
Yep.
you can actually record all your expenses on the EG Tax app and the mileage.
And it's a free app. You go to the App Store and you can download it. Yep, really good point.
Right.
Really good point.
So you go to the App Store, EG Tax, and those things then transfer right to our software.
Yep.
Right?
That's
Yep.
right.
So that'll be so cool. So go to the App Store and get the EG Tax app, and that'll give you can make appointments on there. You can keep track of your mileage. You can keep track of business expenses.
Yeah.
What else is on our app?
There's
Tax law changes.
Tax law changes. You'll get.
the blog.
Oh yeah, I read a blog.
The
Yeah.
blog. The
and
blog.
we can update you instantaneously when something comes down. You'll get a blurb right on your phone. Hey, tax changes or IRS.
I think
da, da, da.
you can check on the status of your
Right.
refund.
And we won't give fake news. All right, let's go. Next question.
Shelley writes in, my mother wants to put her house in a life estate with me and my 2 siblings. I told her to wait because she is only 67 and she may move to be with my sister in North Carolina. Am I right, or does it not matter?
Well, I mean, there's kind of no right and wrong answer for this because putting it in a life estate means that you're protecting it from in the event that she goes into a nursing home, that after 5 years that they won't sell the asset and pay for the nursing home expenses, and she could possibly qualify for Medicaid. So that's the right part. The other right part is if she's really moving to North Carolina, then she could sell her house, and that would mean the sale would be completely tax-free. So that's the other right part. Now, here's the wrong part. If you wait and time, the best laid plans of mice and men. People think they're going to do something, and then it's 2017, then it's 2018, and it's 2019. She still didn't move to North Carolina. She never did the life estate. She becomes ill, and she's too ill. You're to think about putting it in a life estate. Now she goes into a nursing home. The house could be part of the money that has to go to settle her
Proceeds.
Medicare bill.
Right.
Right.
Right. And then also too, like if she does do the life estate now, which yes, there's good and bad. If she puts it in now and she moves 8 years from now, the proceeds of the house will actually go to you and your siblings, which means you will have to pay tax on that money going back to mom's original basis of the house. So if she bought the house, we'll say 30 years ago.
Not if she does the life estate.
Yeah, if she's still alive.
Oh, if she's still alive.
If she's
Okay.
still alive.
Okay.
So then if mom paid $20,000 for the house and now it's worth $200,000,
Right.
you guys have a $180,000
gain.
gain to split between the three of you.
So
There's a lot to consider. It's not a straightforward
right.
yes
So
or
if
no.
you
It's a
inherit
smart-
the house upon her death, then it gets a stepped up basis at the date of the death, whatever the house was worth, and then it would be basically a wash when you sell the house.
That's
But
right.
so you really I would suggest you talk to an elder care attorney who would give you some counsel about doing the life estate. But the life estate really can be an effective tool when you're doing Medicare and Medicaid planning, right?
Right,
That's
right.
very
But
true.
also then if she's in North Carolina, we don't know North Carolina laws for elder care, for Medicare, if they do have nursing homes, because, right, doesn't Michigan, Medicare doesn't pay for nursing homes
Well,
in
they
Michigan? or
will, but you have to be dirt poor.
yeah.
I
So-
mean, New York State is a very socially forward state, and so as a result, it has a tendency to pay kind of cradle to grave for everybody, which is great. It's one of the reasons we have these very high taxes. I mean, when you can avail yourself of it, it's great. And so if mom does some elder planning, she may be able to get into a nursing home with Medicaid as opposed to paying for it herself. So the important thing is to talk to a good Medicaid attorney, elder care attorney. Jeff Katz is one of
Yep.
our sponsors. He's phenomenal with elder care. So I'd suggest you give Jeff a call.
I call him all the time with questions.
And he's so wonderful. Okay, what else we got? Quickie here.
We got Tim from Clarence. EG team. Sadly, my uncle passed away. He was 84 years old. I received $12,000 of his pension money. Do I have to pay a 10% penalty on this money that I received? And so, no, not if you receive proceeds from somebody who has
From an
passed away.
inheritance, right.
And then the good news is that you could back up to $20,000 potentially on New York State. If all the beneficiaries don't super exceed the $20,000 limit per tax year.
All right, so let's back up to clarify this. So on the first $20,000, you inherit first $20,000 of annuities and pensions that are not publicly funded.
Right.
That's going to be tax-free on New York State, provided either yourself or the person who passed away is over the age of 59 and a half. Right.
That's
Correct.
right.
Now, if this were a City of Buffalo pension, and the person who passed away was 50, would it still be tax free to him on New York State?
No,
It would not be.
it would not be, because it converts it, a death benefit converts to a regular pension.
All right. So
So-
even though it was publicly
Yep.
funded,
You lose.
it's not that you would lose, but yeah, it would
You
be
don't
still
get the
be taxable.
benefit. You don't
on
get
New
the
York
benefit
State.
of what the
but
other
if the person's over the age of 59 and a half, then the first $20,000 is tax free, and if they were a publicly funded pension, all of it's tax free.
Correct. And it's all taxable no matter what. On the federal, you just don't have a penalty because it's a death benefit.
Because it was inherited, right?
Yep.
You're the beneficiary.
And
Okay.
sorry to hear about the passing.
That's right. I'm Esther Goulias, the tax lady from EG Tax. We're talking about your emails, and if you have any questions, you can get a hold of us through our website at egtax.com. Just click on the little bubble that says Ask a Tax Question, and I'll be very happy to answer your tax questions for you. We're going to take a short break, and we'll be back on the other side with your questions. I'm Esther Goulias, the tax lady from EG Tax. We're talking about your emails this week and next week, and we're just hoping that you have a wonderful Thanksgiving upcoming week, and I hope you don't eat too much turkey.
Save some stuffing for me.
Yeah. Do you like leftover stuffing?
I do.
You do?
I do.
If it's done good.
Yep.
Yeah.
If it's
crispy,
good
I love crispy stuffing.
Oh.
Anyway. Let's go back to our emails
I
here.
got Mike. Mike says, EG Tax, I hear you mentioning open enrollment for health insurance. Is that something you really can help me with? My navigator I used, I can't get a hold of him. And so we do. We do.
Yeah, we certainly do.
I know for Medicare, it's until December 7th that open enrollment is. But then you can also get health insurance through the marketplace, and we certainly assist you with that at no charge.
Now
And,
now here's the thing, because I see all these commercials on TV, and I just think, it kind of like glosses over your head. The reason that everybody's talking about all these options for your health insurance is because there's you can choose a Chevy, a Ford, a Volkswagen,
Jaguar.
a Jag, and all these different vehicles for your health have different price tags and benefits, okay? Now, you can pay for a Rolls Royce and never use it, leave it parked in the driveway, and all you're doing is really costing yourself money.
Tim, sorry
Yeah,
to step
go on.
on you. Tim, one of our navigators, he says, when I'm sitting down with somebody, I do a health inventory. And what he said by that, means by that, is he wants to know what your prescriptions are, and do you have any upcoming large medical events that you are aware of? And that
Because
health
then he'll
inventory.
then he fits you into what you need.
Correct.
Because if you buy a Rolls Royce that you don't use, then you're overpaying, and you're really on a fixed income. Seniors on a fixed income don't have that kind of money to throw around in
Luxury.
most cases. So
That's
that's
right.
part of why it's so important that you talk to somebody who's going to steer you. That's why they're called navigators. They're going to steer you to see if you get this is $60 a month. If you get this is nothing, and you still get benefits. If you get this, it's $100 a month. And then you can intelligently decide what you need. And that's why open enrollment's so important, and that's why you need to talk to somebody who cares. And I think that if you know us, you can hear
Not
what
a good idea to bury your head in the sand,
And
right?
by the way, we don't charge for it. There's no charge. I'm sorry, Chris.
That's all right. And I know his last part was that he can't get in touch with his old navigator. Well, I can tell you, because we researched.
We have new navigators,
Right,
not
we
just old
researched
navigators.
this all as soon as it started. There was a grant out there the government gave to, around here, it was Kaleida who got all the money, but it was in for 3 years only. The 3 years are up, so Kaleida now would have to pay their navigators themselves.
navigate.
And guess what? They did. They laid them off. So, or they got them a different job inside the hospital. So they don't have their navigators anymore. So if you're someone who used Kaleida,
Did we get a grant?
no, we did not.
Did we charge the taxpayers?
No, we did not.
didn't. No, because we just felt like it would be a horrible thing to not give people the straight scoop and then do their tax return and say, oh, by the way, you owe this, or, oh, so that was part of what we did as a public service. So when we say that we're on your side, we are, and we didn't get money in the first place, so we're not going to dry up our navigation, so to
But
speak.
that was a really good point,
Thanks, Chris. That's
I
a
forgot
great
about
point.
that.
Okay, what else we got?
Esther.
Esther.
This one's just to you, not me or Tiff.
All right, I'm going to answer it all alone.
Okay. I want to sell some stock that my grandmother gave me when I graduated from high school 30 years ago. I don't know what she paid for it, so I know I would pay tax on all the proceeds. Would I be better off selling a little each year so I don't go over $40,000 in income, since I'm on Social Security disability and receive $14,000
Wow.
a year?
What a story.
I really could use the money, but I don't want to pay the IRS a lot.
Okay, so you really, you can't really answer this over the radio.
Well, yeah,
You
but
gotta-
you'd have to ask him if he's married.
Well, I mean, there's so many variables, you know.
Children.
And just because you're paying some taxes doesn't mean that you're going to pay a lot of taxes. And he's probably in the 0% bracket or darn near his.
Well, if
as
he
far
only
as the
has
gain.
Social
Right.
Security right now, he doesn't file a return, so there is no taxes.
I thought you said 40,000.
No, I no, he doesn't want to go over
Oh,
40,000.
oh,
I don't
okay.
know where
Why
that came
40,000?
from.
Anyway.
But you know how people think.
All right. So if he's married and he isn't having to file a tax return, that means that he probably can sell the stock, even with it all being taxable. How much stock did he say he had? He didn't say.
It didn't say.
Well, you got to call us. But anyway, let's just assume that it's
60,000.
60,000 in stock. It sounds like it's all going to be at 0% anyway, because he's in the 15% bracket or less. And he's only going to pay maybe something to New York State.
Right.
So it's not going to be enough to even worry about. There, in this case, if you end up getting 60,000 and it costs you 2,000 in taxes, to me, that's a good deal. But sure, if you spread it out over 2 years, you might save a little bit in New York State. But if you need the money now and you're going to put money on a charge card at 25%, you're better off.
Yeah, because this
but
is going to be a
but
long.
don't do it without talking to us personally.
And this is going to be a long-term capital gain. So, like Esther said, it's going to be a favorable tax status.
Yeah.
You might pay something on New York. Chris?
Also, though, you know, depending what type of stock it was, we'll say it's telephone stock, he could have got dividends every year and reinvested them. So then he has a basis where then it could be a little bit of research. You call up the company and say, can you send me my dividend statements for all these years? And then you have a basis. So maybe you had $15,000 in a cost basis. So then you sold it for 70, you only would pay tax on 55.
But at 0%.
At 0% on the federal, which
Right.
would reduce your state tax. So
Right.
there's, you know, you're trying to be smart, but sometimes
Well,
you
you know,
overthink.
and that isn't that the way it is. Sometimes people are so cautious and they think, "Oh, I really pulled a fast one over the IRS." Like somebody that'll say to me, "I have 2 kids and I'm working under the table and I don't have any other source of income. Aren't I smart?" And I think to myself, "You just lost the earned income credit," you know,
Yeah.
because
and
that's
not to
not
mention
smart.
that they're not paying into Social Security,
Right.
and you have to have 40 quarters.
40
and-
quarters.
Yep.
Okay, what else we got?
I got Terry, Esther, and EG Tax. Any last minute tips I can do to save money this year? I am a single mom with 3 kids, and I live on child support and alimony of $30,000 a year. And that's Terry.
All right. Well, okay. So first of all, if she has alimony and she has children, what's the first thing that's screaming out for this lady?
IRA
IRA is number 1. What else?
and get a job.
Job.
Get a job. You are just so mean to her. But if she gets a job, she'll get an earned income credit,
Yep.
right?
Ding, 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 ding.
I mean,
Ka-ching.
if you have no wages, you can't get an earned income credit. And part of the qualifications is you have to have earned income to get an earned income
And
credit.
so many people think or wish that the alimony was earned income, but it
it's
is not.
And so if she puts some money into an IRA, it reduces her adjusted gross income, right?
Right.
And so then she can make the money. Maybe she made $10,000
Right.
from her wages that would then qualify her for an earned income credit. I bet you the earned income credit is going to be about equal to what she put
would
in the
put in the
IRA,
IRA.
Yep,
right?
yep.
So that would be funded by her tax savings. So I mean, holy kielbasa, go get a job.
And,
Yeah.
and I know
And it
that
doesn't have to be a fancy job.
No.
I know I've had some women who would say, but if I get a job, I would lose that much in alimony.
No.
But there's some divorce, I've seen them, where they say if they start earning money, alimony gets reduced.
Well, I'm talking about earning $5,000.
I know, but I'm just saying, though, like you said,
I think the thinking is
Can I-
flawed. Yeah.
if she made $10,000 and lost $10,000 in alimony, she would still get $5,000 in earned income credit.
right.
So it would be better to have wages
That's
than
true.
alimony.
That's true. That's true. And the other thing is, here's the subliminal thing, is you are in the job market, right? You may be working at a place that says, "Wow, Esther, you really are a great worker. So we have you working part-time in the widget department. Do you think you could work full-time in the widget department? Or we are looking for a new assistant manager, and we'd like to put you and the whole thing is this little part-time job could grow into a full-time job, which ultimately, if she's somebody on alimony, as her children get older and her life changes, I think she would be glad that she has a potential job to come into, you know?
Yep. It's
So-
always better to work. People will also say to me, I'm not going to do overtime because then I'll have to pay more in taxes, and it's always better to work.
It's always, you know, you don't see Donald Trump saying, I'm going to give away all my money because I don't want to pay taxes, right?
No.
Although he's going to get a really nice tax break if this thing goes through. Anyway,
One more fast one?
we have to do a really fast one.
Okay. Esther, do you know, can I still use my minimum distribution to send to charity and not count it as income? Tony with an I.
I believe you can this year. You can do up to $100,000 direct rollover from your IRA to a qualified charity. Then it qualifies for your RMD up to, right? And of course you don't, and you have to put into a charity, but you don't get the tax deduction for the charity, but then it's not income.
Right. And it could also reduce your taxability of Social Security.
That's right, which would be a really good thing
So
because
it's
you
a-
don't have to do your RMD,
Yeah.
right? Because it is your RMD.
Yep.
Right.
Okay, I'm Esther Goulias, the tax lady from EG Tax. I'm here in studio with Tiffany Fabian, Christopher Fabian. We hope that you guys have a wonderful Thanksgiving together. I hope your families are blessed. I hope everybody's happy and healthy. And don't fight with your family. Just keep eating turkey. Until next week, I'm Esther Goulias, Chris Fabian. God bless you. Thank you for listening.